Hi everyone, and welcome to my Q1 quarterly conference call. It's great to see some familiar names. I think some of you joined us at the recent Machine Learning and Investing conference, so it's great to see you again. I was excited and loathing this conference call in equal parts this time, partly because 2022 was such a volatile year, but that also gave so many lessons, and equally excited about the opportunities that's ahead. So hopefully we can go through some of those today. So the agenda for today will be to have a look at my investment strategy and maybe discuss a little bit how that has perhaps changed or been adjusted over the last year, but also since the inception of the portfolio almost 7 years ago now. I'll then do both a review of the market as well as my portfolio before I move on to my market outlook for the year, as well as discussing how the portfolio is positioned to take advantage of some of those analyses. For those who haven't been to one of these calls before, or those who don't know me, I'm Heloïse Greeff. I am the person behind the Rubymza portfolio on eToro. I joined eToro in 2016, and since then I've had more than 175,000 people follow my portfolio, and over that time span I've had more than 20,000 people copy the portfolio at one point or the other, with more than 50 million in assets. That's also given me the great opportunity to share some of my learnings through this journey by doing lots of media interviews and conferences. And if you spend some time with me, you'll really understand that my main obsession was to find my own financial freedom. That's why I joined eToro in the first place. And since then, not only take people with me, but also empower people by disseminating some of those learnings and information available to us. So just a brief introduction of myself. I am originally from South Africa, but came to the UK, to Oxford specifically as a Rhodes Scholar in 2013, where I studied biomedical engineering and later an MBA. I then went off to work at a startup in Kenya before returning to Oxford to do my PhD in machine learning, where I also hold 2 patents and a few publications. I continue to live in Oxford. I just love this city. I love the intellectual stimulation that is around. So this is a new slide, but I thought it would be useful to just do a brief overview of my portfolio. Sometimes this information is difficult to find on eToro. Sometimes it's good to remind ourselves what portfolio we signed up for in the first place. So my portfolio is a long-term equity portfolio, although when we look at the distribution or the allocation, we'll see that it's currently being shifted around. We'll discuss that and how we'll get back to being predominantly an equity portfolio, but we do focus predominantly on growth stocks. Again, that allocation has been slightly adjusted at the moment, and I will discuss that when I'm going over the portfolio. I try to keep my risk at around 3 to 4. Last year I think it went up to 5, but we're back to 4. So if you can't tell, this is really a sort of middle of the road portfolio. My main aim is to have compounded growth over the long term. Here I mean at least 5 years. I'm very fortunate to have a 7-year track record on eToro, so everything I say can be backed up by my actual track record. But yeah, the point of this portfolio is to have a sort of not too comfortable, but comfortable enough ride where there's not too much volatility, and that's why I try to keep the risk score on the lower side. My investment strategy has 6 main pillars. The first 3 is what I call the basics. They are the ones which are out of textbooks. They are the age-old adage of investing, which I have taken a combination of to make my own. The first, as I said, is to focus on long-term compounded growth. So I rarely or never take profits out of the portfolio, and I always use them to reinvest back into the portfolio. And that's part of my success, where I've had this compounded growth over the last 7 years. As I said, I try to reduce the volatility with proper risk management, and then I use strong fundamentals to keep an eye on the current economic environment. The second layer I add to this is what I call me. It's the things which are uniquely me that I add to the portfolio that brings my outlook. So the first is using AI and machine learning analytics. As I mentioned, I have a PhD in machine learning, so this is my way of viewing the world. It's my way of analyzing large and complex data sets. However, I would add to the caveat that this is not a pure kind of robo portfolio. I don't use the eToro APIs to automate all of this. I simply use the AI and the machine learning as an additional decision support tool to assist me in my decision making. The second one is trying to keep the fees to low or zero. It's one of the things which attracted me to the eToro, and I very rarely take any leverage or have any fees associated to the portfolio. And the third one is using the hive mind or megatrends. It's something I've been quoted for in Bloomberg, and that's just an additional data set which I think we never had access to before. Of course, 7 years ago when I started using it, it wasn't as widely used as now, although now we have so much more data to keep adding to those insights. So this is my investment strategy. It's my 6 main pillars. It's come with a bit of trial and error when I first started my portfolio in 2016, but it's become the sort of bulk of what I revolve my portfolio around. So now let's move on to our market review for 2012. Well, what a tumultuous year it has been for the global capital markets. And not only did they have to contend with a lot of economic headwinds, but also a lot of geopolitical instability. And that especially after the COVID era, when I think we were all hoping to catch a breath at the end of 2021, which of course just didn't happen as we sort of reared into these inflation measures, trying to keep this 40-year high under control. Of course, we were to some extent expecting that, because we had these really ultra stimulative fiscal and monetary policies to help support the economy to keep going globally during the COVID pandemic in 2020 and 2021. So we were expecting some of that to come to an end, but of course it's very difficult to predict exactly how that's going to play out, and we saw that a bit this year. Then we had the supply chain disruptions that continued, and we saw a lot of consumer spend shifting towards goods away from services as people are starting to feel the delayed or the lagging effect of inflation. And then of course it feels like forever ago now, but only February last year was when the Russia-Ukraine war started, and throughout 2022 everybody sort of kept eyes on China's zero COVID policy. So a jam-packed year full of a lot of action, and after the bull market that has been going since the global financial crisis in 2008, 2009, markets experienced a massive pullback, and for a lot of us that was our first time experiencing such a pullback, and that has been really uncomfortable and unsettling for a lot of new investors. But hopefully by talking through it, we can help set at ease some of the concerns that you have, both in terms of markets, but also in terms of the portfolio, to reassure why I'm still committed to this portfolio. You might remember that in July last year, I almost doubled my own deposit, and I now enjoy seeing copiers who started copying me in October who are now doing extremely well with their copy position. So it is a bit about timing, but over the long term, those sort of short-term fluctuations can be eased out. Of course, in 2022, we also saw almost all of the 15 out of the 20 most important central banks tightened increase their interest rates, and the biggest impact was the Federal Reserve hiking interest rate. We saw almost overnight FFR by 425 basis points across 7 different meetings in 2022, and that's equivalent to 17 25 basis point rate hikes. And just to put this into perspective, this sort of step up of 25 basis points happened equivalent to 17 times. And at the beginning of 2022, markets were sort of pricing in for this to happen only 3 times. So you can see the scale of the aggressive interest rate hikes that we've seen, which even though markets were expecting it, I don't think they were really expecting the sort of aggressive approach that we did see. And the effect of that was widespread throughout the market. Almost all the US equity benchmarks had their worst annual performance since 2008. You can see on the graph here, not a single of the major benchmarks were kind of spared this last year. And our portfolio followed the same. We sort of saw the blue chip Dow Jones industry, which is the green one here, on a scale of how good to bad, even though even that was down by nearly 7%. And that was purely because of the price weighting methodology that benchmark uses, and the greater percentage in that benchmark that is being assigned to value style members. And of course, we'll talk a bit about the rotation from growth to value that has happened, not only in the market, but also what we're doing in the portfolio to prepare and address that. Our portfolio usually sort of lies between the S&P 500 and the NASDAQ 100, or the NASDAQ composite, which is kind of convenient for everybody because we use the S&P as our benchmark, which means we're almost sort of above that in previous years, but just below the NASDAQ. And this year it was the same. If you've checked my portfolio recently, it was down double digits in 2022. And I'll talk a bit about how, it was the first time we had a negative return after 5 consecutive years of being in the green. The NASDAQ really dipped deep into the 32% lows, and that was in large part due to the strong weighting again, which that benchmark gives to mega cap growth style members, which were disproportionately impacted by the historic rise in interest rates, which I've just discussed. That is sort of part of the impact which happened with our portfolio, because we are, as I mentioned, predominantly a growth portfolio. The sort of same was true sector-wise as well. I think in terms of sectors, out of the 11 sectors, there were not many that ended in the green. Energy kind of led the way in sectors, followed by a 65% return in 2021. So yeah, the sectors struggled as well. There was really nowhere to hide. We discussed this when we met in October, and it was the sort of defensive utilities, staples, and healthcare sectors that finished kind of break even in this year. Although those are typically ones that do well in inflation, they did not kind of give us that relief that they normally, or the textbook relief that they would usually give. And it was the growth heavy communications, consumer discretionaries, and specifically the technology sector that were the largest underperformers, and they were also the biggest representation in this portfolio. So we really felt the pressure this year. So as I mentioned, there was this kind of shift away from growth to value, partly because of these aggressive interest rate hikes. And this was, as I said, mostly driven by this surge in inflation that we saw when the Feds especially pivoted away from their hawkish kind of transitory inflation outlook to taking a more profound impact of the rates and how they're going to address the spreads of that. And just to explain kind of why we saw this different impact on growth stock versus value stocks. So in financial terms, we have a term called duration, and duration really measures the sensitivity of an asset's price to changes in the interest rate. And when we are in low or falling interest rate environments, as we have been for a long time, we really want to own assets that have a high or a long duration, because they tend to rise in price the most when interest rates are falling. And examples of these would be, long-term bonds, or the ultimate long-term asset, growth stocks. And then the converse is also true. When we are going into interest rates beginning to rise, the long duration assets experience the most drastic or dramatic falls. And this is precisely what we experienced in 2022. We saw one of the most glaring rotations away from growth style leaders at the start of 2022, which we suspected, but it happened in part, as I said in our previous calls, a lot sooner than I at least anticipated, which was partly also brought forward by the war in Russia and Ukraine, which started in February. As I said, this all was aided by one of the fastest rate hike cycles which we have seen in the market since 1981, and value really outperformed growth by more than 20% in the last year, which marks its second best outperformance on record if we look at the Russell indices going back to 1979. So really a phenomenal year for value, and that's why when people start to compare popular investors, you really end up comparing different portfolios, and the value that the more heavily value portfolios tended to do a lot better last year. And yeah, and then finally just the geopolitical headwinds which we saw. I think I've addressed a lot of that, but the kind of knock-on impact of that was the commodities, particularly food and energy, which were unusually volatile, in part due to this invasion in early February. We took advantage of some of that with some very profitable positions in palladium and wheat specifically. So 2022 has certainly been a year where I think myself and the broader markets, all of us have learned a lot, and I hope through your being part of the market, you're attending these calls, you have also learned a lot through that. So now coming to the portfolio performance, as I said, this was my first year that the portfolio had a negative return since 2017. So I had 5 consecutive years of positive returns followed by last year. And as uncomfortable as that was for both myself and I'm sure for all of my copiers, if we look at the long-term outlook, if you invested $1 or $100 at the start of 2017, that would have still more than doubled by the end of 2022. So despite that deep dip in 2022, the portfolio is still well ahead of our benchmark, the S&P, if we take a more long-term view. And this is sort of where it becomes tricky when we have these quarterly conference calls, because I think a lot of popular investors sometimes feel a lot of pressure to look at the performance of the quarter, and sometimes that can be a bit misleading because we make decisions within a quarter which, a bit like the inflation rate or the interest rates effect on the inflation, has a bit of a lagging effect. I think you'll remember if we met last quarter, I showed a bit of how the changes I made in June were coming through in the quarter. So yeah, a lot of that happens, but overall you sort of, I think the most important thing for any popular investor or for anybody who has a large portfolio is to stay true to your strategy, because what you don't want to do is you don't want to be hopping between strategies, because that means you might be missing out on the next bull market in our case, or the next upturn. And a lot of research has shown by trying to sort of dip into the best of both or the best of everything, by missing out on those really highs, you miss out on the benefit of a long-term strategy. So for example, if in this downturn or this downturn you had hopped out of this portfolio style, you would have missed the kind of long uptrends that follow. So I'm very fortunate that I have a long-term track record of more than 7 years, so I can kind of give this zoom out view of what that impact is, because this is in line with the long-term vision of a portfolio like mine. And sometimes it's easier just to forget those kind of jagged up and down. Sometimes it's easier to just not check in on your portfolio and to just enjoy the smooth ride of that kind of upward average growth over the long term. In terms of the portfolio review, I think the thing which I am the most proud of for 2022 is If you look at the number or the percentage of profitable trades that I've made over the last 2 years, it's the highest amongst the top 10 sort of popular investors on eToro, and it's 67%. So this is a metric that depends on your style of investing, you may or may not follow, but it's one that's quite important for me, and I'll explain to you why. So what this means that 76% of my actual closed trades were profitable. And as I've discussed with you previously, that not all positions that any investor takes will ever be correct. The kind of benchmark is 60 to 80% of them will be correct, and the rest of the game-changing thing is how quickly you can cut your losses on the ones that don't work out. And there are always a couple that don't work out. The reason I aim to have a higher end on this metric is because I believe that every decision that I make in my portfolio has a cost. It has a cost of my time, my energy, the computational power of myself, my team, as well as my machine learning algorithms that are running. And so rather than just trying my luck, we really try and make fewer but really high quality decisions. And when I compare this benchmark to a lot of my other peers, I'm especially proud of this because I think it's in line with the portfolio strategy and objective. We really aim to make a lot of high quality decisions, and to me that proves that it's not just pure luck, it's not just me getting lucky. If this was 50%, it's as good as me flipping a coin. If you know anything about statistics, you'll know flipping a coin, you're 50% chance of getting heads versus tails. And so I got a question about how much do I think machine learning sort of contributes to the portfolio, and this is really where I think it comes in. I think it reduces the computational cost, both of the energy, time, and effort that the team and myself put in to make these decisions. It's able to analyze a lot more data, and I think that's why this metric is higher than some of my peers on eToro. Just a few other things which happened in the portfolio this year to remind you if you haven't been to any of my other calls. The first was the red readjustment, and this kind of links back to this number. So I usually had a percent of profitable trades of nearly 80%. It was something that I prided my portfolio on. But the red readjustment, as I called it, was closing a lot of positions which I would normally hold on to, but closing them in red simply because the market had pivoted so strongly and so swiftly because of this aggressive interest rate hike. So this has sort of lowered this number for me, but we're working on getting that back. But the red readjustment was a big step away from how I would usually trade, and a kind of response to what was happening in the market in 2022. The other thing which I spoke a bit about, which is starting to wind down for this year, is short selling and taking leverage. Again, that is something that I don't normally have in the portfolio, but something that we introduced in the second half of 2022 to try and kind of buffer us against the volatility in the market. We still have a bit of hedging positions in the portfolio, but as you can see, we were at about nearly 8%, now we're at 2.5%, so a lot less, and I'll talk about where that funds or capital is being deployed instead. The last note, which was a big event, of course, was the big deposit I made in July, but that has brought up a lot of questions, including a question on the post that I made for this invitation to this event, and that was around desyncing of copiers if they did not keep up with that deposit. So as I've discussed then and now, I on average hold positions around 4 months, and because of the high volatility in the market, the portfolio is currently being managed a lot more actively than it would be in a normal bear market. And because of that high turnover rate, I do anticipate that the desyncing will be minor. There will be desyncing for a few months perhaps, but again, in the view of a long-term portfolio, if we're talking 5 years plus, then the short-term desyncing, which happens when this turnover of my positions happen, is really not a significant problem. So with 2022 fully in the rearview mirror, thankfully for a lot of us, what is the market outlook for 2023? Because stocks are currently trading at a massive discount, but you'll see I'm still holding some large portion of cash because we are waiting for some more evidence that we are fully in a period of long-term economic rebound. And so we are seeing this moderating inflation, which is sort of, we saw a rally in this January. And if you were at my last call, you would know that I predicted this sort of L-shaped recovery period. So we're very used to a kind of V-shaped, which happened in 2020, where the market falls drastically. You can see that very clearly here. The market falls drastically and recovers as fast. So, you know, we're sort of anticipating or expecting that kind of recovery. And that might not be the case yet. There might be continued sideways movement. There might be a continued, as we saw these few kind of mini rallies that happened in 2022, which are opportunities that we will be looking out for until we reach our next bull market. But until then, we will be in a bit of prolonged kind of recovery period. As you know, for my market outlook, I usually take a bear view and a bull view. Of course, there's a lot of consensus that it'll definitely continue to be a bear view, but we want to be optimistic and we want to be prepared for the alternative scenario. While the Fed and the broader market certainly do not currently differ very wildly with their forecasting and pricing for this cycle's peak terminal rate, which we anticipate to be less than 25 basis points, futures are pricing in rate cuts by the end of summer, which means that by the second half of 2023, we will start to see those rate cuts. But there is also increasing uncertainty as to how severe the coming slowdown will be. And to just add to that uncertainty is the lagging impact of the rate hikes and the conflicting economic data that we're seeing and the volatility that comes with that. So what do I mean by the lag? Well, the economic data has been really mixed because there's these lagging indicators such as inflation, for example. So if the Feds cut the rates today, inflation doesn't immediately go down. And this makes it this really tricky kind of back and forth dance where you have to turn the knob a little bit and wait to see the outcome before you turn the knob again. But sometimes in the case of the Fed, with their aggressive approach, the data is either too conflicting or they turn the knob before, you know, we fully felt the impact of the previous rate cut. Other examples of that has been employment, job openings and wage data, which are just holding near to the recent highs. And this just gives the Fed kind of cover to keep the rates elevated for perhaps longer than needed, which in turn means that we're no longer anticipating the soft landing that you might have heard the media talking about, but that there is consensus that there will be a full-blown recession in most of the large economies, if not globally. So for the US equities, which are represented by the S&P, which is the kind of flagship that we use, the near-term rallies that can happen tend to happen at any time, especially in a period like this where there is widespread negative sentiment. And a good example of that is what happened last year, because we saw the first two kind of significant rallies give 13% and 19% gains, which sort of clearly defined the resistance. And then the third rally, which happened in October of last year, that gave an 18% rise. But if we use these rallies, and we have to remember these rallies are kind of somewhat unpredictable because they are in part driven by the equities put and call ratios, as well as by the sentiments of fund managers or analysts, like you would sometimes see these sentiment outputs. So in October last year, the low marked, very interestingly, was around 50% of what we would call like a Fibonacci retracement. So compared to the post-COVID uptrend, which spanned from March 2020 to about here in January 2022. So that means we're sort of at the current resistance is sort of at 50% of this Fibonacci retracement. And what does that mean? Well, that means we're perhaps expecting even a few more lows. And if we see these new lows, then the Fibonacci replacements kind of project that we could go down to represent a 35% decline. So that means that we probably have a bit more discomfort to come. But as I said, even in these downturns, there are a lot of opportunities for uptrends. Make use of that. The kind of optimistic bull would say that equity performance following prior inflation peaks on average, not always, but on average, has always been very positive for equities. There's been double-digit growth, on average 11%. Of course, in some cases, at least two cases in 1929 and 2008, there were double-digit drawdowns or negative growth. So there is a lot of opportunities in select growth stocks. It's just that we have to be a lot more selective about the growth stocks that we include. And I'll show you how the portfolio is kind of geared at the moment for that. But yeah, it will come with a painfully slow slowdown in the economies around the world, and earning growth will probably be at a high as interest rates will take some time to sort of fully permeate through the economy. So that means even though we're predicting that interest rates will go down towards the middle or the end of this year, some of the effects of that will take some time to get through the economy. But of course, the upside of this is that it is preparing the markets for the next bull run. It's exactly what market cycles do, making the economy more robust, flushing out any sort of fat, trimming fat, and preparing the economy to be more robust to go into the next bull run. Plus side would be if we see interest rates ending sooner, maybe before the summer, but that's unlikely, I think. Crypto has shown some resilience, which we discussed when we met last time. And then I think the major thing, as those who've been at my calls before would know, that I like to take all the information into account and then look at it kind of from a very different perspective. And that's this last point about the shift in investor psychology. So I grew up in a developing country where we always had inflation. For a lot of people in developed countries, in their 30s, this might be their first taste or experience of inflation. And what that does is there's this distinct shift that can happen in investor psychology. What I mean by this is that the sort of upside of taking the risk of investing becomes a bit diluted when interest rates are high. So if we say on average the stock market makes a return of say 10%, in low interest rate environments, the risk of investing in the stock market is worth the upside, because if your bank is giving you 0.05% and you can potentially earn 10%, a lot more people have access to cheaper money because interest rates are lower, but two, are willing to be more risky with their investments because the upside is potentially higher. When we see a high interest rate or an inflationary environment, that gap kind of closes, and that has a knock-on effect on investor psychology. So be aware of this. Be aware of how it's affecting your thinking. What I mean by this is if interest rates are going up and banks are suddenly offering higher interest rates, 3-4% perhaps, the gap between what the stock market offers and what your bank is offering is reducing. So for some investors, that means their appetite for investing might reduce. And that's almost the opposite of what you want to be happening, because as I just said, a lot of stocks are currently at a reduced rate. So be aware if this is happening with you. Be aware if you're feeling discomfort that stems from this kind of shift in psychology because of the wider economic environment, especially if it's your first kind of taste of inflation. What is the portfolio outlook based on this market outlook? Well, the first thing which I included in the portfolio, which hadn't been there before, was gold. And we talked about this a bit in our last meeting, but gold has really had quite a very unimpressive performance, especially in an inflationary period where we expected it to kind of be a buffer or a safe haven from what's happening in the wider stock market. Gold is currently still in the portfolio, very reduced exposure, but there is some kind of thinking around that the trend of underperformance in gold might be ready to change. And yeah, it'll be interesting to see whether it is able to return to being that typical safe haven that is offered by treasuries that have seen their steepest decline in the modern times. Lack of performance by gold has also sort of had this knock-on effect of damaging the confidence in cryptocurrencies, because I think a lot of people, outright gold, Bitcoin, digital gold, and so compounded by the fallout of FTX scandal, there's been a lot of cryptocurrencies crashes, and in my opinion, and you'll see when I'm talking about the tech trends for 2023, creating a lot of opportunities. So we continue to hold about 5 to 8% of crypto in the portfolio, and when I discuss the tech trends, you'll see why. In terms of the cash in the portfolio, when we met last time, I just made the large deposit, and I stated that I was holding on to the cash until we see better opportunities. Of course, at the moment, as I said, we're not quite sure that we are in a growth economic and that we are seeing this L-shaped recovery. So I've started moving some of that cash in the portfolio into short duration treasury bonds. And as I just discussed, when interest rates are increasing, we do favor sort of short-term duration assets. So I've picked a short-term duration treasury bond. They're currently yielding around 4.4% per year, which is obviously a lot better than what cash can give us. But what that is offering is it's offering us a kind of short-term stopgap with these risk-free bonds to just get a little bit of yield from them, but still have a bit of liquidity almost ready to go when the markets do change. But the goal is still ultimately to be fully invested in equities, and this is just a short-term stopgap that I would point out to you. And that's the same with the distribution of value versus growth. The portfolio usually has about 80% exposure to growth stocks. When I checked yesterday and this morning, we're around split 50-50 between value and growth, and that's just again to sort of buffer us. I will never take it more than this because, as I said, we're still a growth portfolio. Some of these value are also some of the ETFs that I currently hold, so they're not true value, but that's kind of where the portfolio is in terms of the holdings for going into this year. Then just to talk a bit about some of the tech trends, because I still see this as a majorly, tech-oriented portfolio, partly because of my bias, my love, my interest, and my obsession with tech probably, but it's what I love and understand. So the kind of main trends I'm looking out for and gearing the portfolio for in terms of the tech trend is the impact of online penetration. So after COVID, we of course all moved online, but a lot of the markets kind of anticipated that this online penetration would retract as it did in 2021 when a lot of lockdowns started to be lifted. You can see that there was a massive dip in e-commerce penetration in 2021. But what we're starting to see this year is that our lives continue to remain online despite us being allowed out again, probably because we've started to do a lot of things which we wouldn't be able to do otherwise, like meet with all my copiers from around the world, which we wouldn't be able to do in a quarterly basis just because of the logistics of it. So that gives us a really strong position in some of the stocks that are leaning towards more e-commerce. That's why you'll see Amazon and the likes back in the portfolio, or still in the portfolio. The second one is what I call social commerce. You know social trading, you know it's a combination of the best of both, and social commerce is the same. So we see a lot of online predictions about the reduced advertising revenue of Amazon and other e-commerce platforms. But what that does not take into account is the shift of the same kind of capture and attention and output of advertising, but what is now happening in the influencer space on social media. And this really gives certain firms that are very well positioned, like Pinterest, Meta and Google are both in the portfolio for that reason, and Alphabet, a good advantage to take advantage of this shift towards what we're calling social commerce. And that's when e-commerce is being driven by social media rather than by traditional advertising. So it's just a shift in those kind of advertising stream, and it may take a while for them to figure out how to capture these revenue streams. And then the fourth one is, of course, cloud and data. You know it, my favorite. Both Amazon's AWS and Microsoft Azure are very, very well placed for delivering stunning growth as we see more businesses who dedicate more of their kind of business opportunities to going online, to going into the cloud. And so this is more a long-term play because we do anticipate a little bit of reduced spending on this, especially as technology companies are forced to become a bit more thrifty in this high interest rate time. But definitely, in my opinion, a very strong long-term play, because I don't think we will be able to get away from this trend. And then finally, the last one, which sort of links back to my first comment on crypto, is Web 3.0. Of course, we're not really sure where it's going yet. I don't think anybody has figured out virtual reality, augmented reality, artificial intelligence. It's kind of permeating through our everyday lives, and we're having touch points with it in a lot of multiple places. But I think the one thing we agree on is that these are, in my opinion, the next big thing, and that's sort of where it links back to crypto, because I think that will fuel a lot of what happens on Web 3.0. We have exposure to these developments through semiconductor, through traditional tech, but also, as I mentioned, just purely through holding crypto. So as always, in terms of going forward, I will continue to do my forecasting and my analysis to make sure that the portfolio remains a sort of stable in terms of risk score. The portfolio will remain net long despite its kind of temporary shift towards holding a bit more value stocks or holding a bit more bonds. That's just to kind of give us breathing room to get through the market outlook that I've laid out for you for the year ahead. For you and for me both, I continue to reiterate patience and discipline. It's my absolute golden rules. I always say you'll get sick of me saying this. I'm gonna have these printed and like put them up behind me, because I think it's so easy to get swept up by the emotions that happens in this kind of turmoil markets that we just throw everything out the door, and that's the biggest mistake we can make, because we pay for it when we make emotional decisions in the stock market. As a reminder, I always remind my copiers to continue depositing. Those who did deposit at the end of last year are seeing amazing returns on their copy positions, just because you're buying stocks at, if I'm holding a stock which is 30% down and you add to your copy, you're essentially buying that stock at 30% discount. And yeah, I just wish I could buy more. I wish I could copy myself more. So yeah, it is a brilliant time to keep adding if you can. I know it's a very difficult time with inflation going up, in the cost of living crisis in Europe, but This has always been my first and most important rule in investing, is to continue depositing frequently, because that gives you the advantage of dollar cost averaging. The second reminder is just about my mailing list. Some of you did come to my event last week about machine learning and investing. We're going to be exploring that a bit more. Invites will be going out through my newsletter or my mailing list. So you can sign up for that by scanning the QR code here or by going on my Linktree. The recordings for those, of course, are also available on my eToro page as well as through the newsletter. And then just a final note on, of course, you all did contact me or reach out to me through eToro, but I just want to remind everyone to be careful of the numerous scams, spams, and opportunists who are out there. It's partly why I'm running the webinars, because I think empowering ourselves and educating ourselves is the only thing we can do to make sure that we don't fall victim to any of these. So please join me for one of my upcoming webinars. And with that, I am conscious of time. Thank you so much for giving your time to come to this presentation. I really always enjoy, spending time with my copiers. It's not often that I get the opportunity. So thank you so much for coming. And thank you also so much for your patience through this very, very difficult time, but hopefully you're as excited as me about some of the opportunities that are ahead, but also seeing the portfolio performance over the long term will just give you a little bit of a reminder that in the blip of 10 years or 5 years or even 20 years, a 1 year negative return is really only making us stronger and giving us opportunities to go in and take advantage of those returns. Thank you so much for joining, and I look forward to seeing you at my next conference call next quarter or at one of my other webinars in between.